Hi and welcome to Building Blocks with the MPP Group, where today we're going to look at the 4 basic types of lending that you're going to need to access to build your property portfolio. Okay, so part number 1 is the simple buy-to-let mortgages, also available on lending on HMOs and also commercial property. But if we just stick to resi right now, we're probably all aware, and we've got some really good video on why we use mortgages, but residential buy-to-let mortgages is the first thing that you probably need to get your head around in property investing. They usually come at 75% LTV, which to jargon bust for you is loan to value. That means they'll lend you 75% of the value of the property and you need to put in 25%. Lenders, there's probably at the moment 2 or 3, to my knowledge, in the market that will go 80% loan to value, 85% loan to value potentially. This seems to change at different times based on lenders' criteria and their perceived risk in the marketplace. So understanding that, going to speak to your broker and getting a sort of full rundown of who's in the marketplace and who you can access, because people can access different amounts of mortgages based on their personal circumstance and their history in the property market and their experience. As a general rule of thumb, to access most of the mortgages that are in the buy-to-let property sector, you need to be earning £25,000 a year and be in full-time employment. It helps if you own your own home, but it's not an absolute necessity. Number 2 is bridging loans. So bridging loans, and I'm really trying to sort of give this in layman's terms, bridging loans are very quick mortgages. Say very quick, I've had some pretty slow ones as well, but the concept behind a bridging loan is bridging the gap between your purchase and your mortgage that you'll sit on for investment purposes long term. So they're meant to be very similar to mortgages in their loan to value, their LTV. You should be able to access them at certainly 75% LTV. A bridging loan should come in, could be done in 2 weeks, give you access to property quickly. So if the property needed to be bought very, very quickly, you might think, right, not got time to mortgage this, gonna have to jump in on a bridging loan and then we'll move into a mortgage longer term. But also, and probably key to bridging loans, is it's bridging the gap between a property being bought very distressed, so a non-inhabitable state, maybe no bathrooms, maybe no kitchens, maybe it's just an absolute shithole. And then you can buy on a bridging loan, do a refurbishment, and then obviously exit onto a longer term mortgage. What else do you need to know? Oh yeah, they're super expensive. That's the downside. So it sounds brilliant, but on a mortgage, I always think on a bridging loan, you're probably going to be paying around 12%, maybe 1% a month. There are usually fees into the bridging loan and fees out of the bridging loan. So look out for these, and then a lot of bridging lenders will make you pay for their solicitors' legal fees as well. So it can be quite an expensive model. Certainly something that you need to factor these expenses into your deal analysis to see how that stacks. So number 2, bridging loans. Number 3, development finance. So development finance works quite similar to a bridging loan, but they will also lend on the refurbishment of the property as well as the purchase of the property. So the theory is that in development finance, there are lenders out there that will lend at 75% of the purchase price of the property plus the full refurbishment costs. Now here's the caveat: as long as the amount of money that they're in for does not go higher than a 65% loan to value on the end value of the development. So the 65% LTV of the total gross development value, GDV, of that development. So that can be tricky, and you need to sort of factor that in. The reality, the way I've seen it, because again with development finance, they will be fees in, there will be fees out, you'll pay for solicitor fees, this, that and the other. They're very smart. They don't actually over leverage themselves at any time. Often, I think, rather than it being 75% of the purchase price and all of the build cost, I think you're probably better off looking at around 65% of the purchase price and the build costs, or maybe even slightly less. But a really great facility, and fundamentally, you see the guys doing big developments. I think our biggest at the moment going into planning is 40 flats. It's not really possible without access to development finance. This is how people leverage up, scale up, use lots and lots of other people's money to do bigger and bigger things. They're usually using development finance. The downside to development finance, because I know there's a few of you rubbing your hands together thinking, I can get, you have to put in maybe 35%, 25% in theory of the purchase price, and then somebody will lend me absolutely everything else, is they have a minimum lend. Usually, if you're talking multiple dwellings, you're talking apartment schemes, new build schemes, commercial to residential development finance, they've got a lot of money to lend. They don't want to be mucking about with 100, 200 grand. Usually, you're in for quite significantly more than that. We're going to be accessing sort of probably £3.5, £4 million worth of development finance on this next one. The least I've ever had on development finance was actually, it was a residential HMO. So 2 residential HMOs right next to each other, both 5 beds. You could call it a 10-bed HMO altogether. I think the build was around £160,000 at the time, and they gave me development finance on that. So they access around 60% loan to value on the purchase of the property and the build. So they probably lent 250 in total. So that's as little as I've had. Again, different development finance lenders, different criteria. There are some that will go sort of down that 250 level, and there are some that probably won't touch you unless you're spending £500,000 or less, or more, sorry. So that's number 3, development finance. And number 4, and probably most importantly to get your head around, is angel investment or private lending. Now, I am a massive fan of angel investment. We've used it from the first day we entered the property market and use it very aggressively still today. Why do I love it so much? 2 reasons. One, it's quick. It can be quick and it can be simple. So if you've developed good relationships with people who've got a lot of savings in the bank and they don't really know how to get a good return on that money because they're not in the property sector or they're not institutional investors, you can offer them a really good return on their money just by lending into your property deals and you using that cash to get the returns that you know you can get. We, for example, with 2022 at the moment, offer an 8% residual return, so we'll pay people on a monthly basis 8% interest on their money, or we'll roll that interest up to the end of a year or the end of the term. It could be a 2-year term, and we'll pay them 10% interest on their cash rolled up and paid back at the end of the loan term. So 8 or 10% on your money is significantly better than Joe Blogs next door knows how to get a return on his money. So it's people helping people. It's access to money for you without the crazy legalities and silly costs of lending through some bridging finance, development finance lenders. It's quick and it's simple, but it's really people helping people. You're genuinely giving people a great return, and you're taking that money, you're taking all the risk, and you're moving it forward to try and squeeze that to generate a better return for yourselves in the future. Okay, so to recap the 4 basic lending scenarios that we've got: mortgages, buy-to-let mortgages, think 75% loan to value, think long term. Bridging loans, think quick, think expensive, but think if you're buying a distressed property that you need to get your hands on and you don't have the cash, bridging loans the way to go. Number 3, development finance, think scale, think development, think commercial to residential, new build, think projects and funding bigger projects. And then number 4, angel investment, think absolutely everything. Think deposits for projects, think funding smaller deals. If you've got big angels, think funding big deals. These guys, you're going to need to scale your private lending alongside your property portfolio. Quite a lot to get your head round, but it's a snapshot of the world that you're going to be entering when you're looking to invest in property, build a portfolio, and build some financial security for you and your families. Hopefully you got something from today's video. If you did, please like, share, and follow the channel, and we'll be seeing you soon.